Welcome to Small Biz Life, episode 18. 5 common tax errors plus 3 opportunities to save. Does this sound familiar?
Oh my God, I have so much to do today.
Don't forget to breathe.
But I have almost 400 emails in my inbox and 30 phone calls to make.
Have you looked into getting a virtual assistant yet?
Oh, and I need to schedule all my social media posts.
Did you drink anything today?
I had coffee.
Did you eat today?
Did I mention coffee's a bean?
This is Small Biz Life.
Welcome back to Small Biz Life. This is episode 18.
Woohoo.
And I am Kristin Ingram.
And I'm Jeffrey W. Ingram.
And this week we're going to talk about something very exciting that lots of people love to talk about: taxes.
Sorry.
So it is officially tax season in the United States. So we're going to talk about some common errors that small businesses make and a couple opportunities for 2016.
And from looking at one of these, from my pathetic knowledge of not really paying attention to what Kristin does, there's at least 2 ones that I think really are business killers in there.
Yeah. So we're going to talk about that this week. But before we get there, we're going to talk about what's in the news. So what did you find that was interesting this week?
So I found this very good article in Tech Republic, 3 critical elements to a winning gamification strategy.
Oh, that sounds like a Jeffrey article.
Yes, as a person who loves games, I love the idea of gamification. And to briefly let you know, this is something that can be done in any area that you're trying to increase engagement in. So if you have employees and you're trying to increase employee quality or productivity, you can create strategies along these lines. Yes?
I have a question.
Sure.
What is gamification?
Gamification is applying game-like elements to everyday activities.
Okay.
Mm-hmm. And you can also use it if you want to create better community engagement. These strategies can work pretty much anywhere. I believe they're probably best suited for mundane activities or activities where you really need to get participation. And so I will cut kind of to the chase. Kristin will put a link to the article in the show notes so you can read the whole thing, which you should. But here's a few things that I think you should, the 3 key things to take away. 1, you need a clearly defined and achievable outcome, making it clear how you win. So let's use, for example, you want more engagement because you're having a product launch. Rafflecopter, that would be considered gamification because you are rewarding people. You're giving people points essentially for sharing out your content. And then at the end, depending on the way the prize structure is, you hand out some prizes, which you have to do to make sure it works, or else your reputation's ruined and it will never work again. But it's a way to help ensure that you have people who are interacting with your content. And that one's very simple. You know, you have a list and say, hey, if you share this on Facebook, you get an extra chance to win. If you share it on Twitter, you get an extra chance to win. On Pinterest, you get an extra chance to win.
If you join my email list, you get an extra chance to win.
Exactly.
Yeah.
And those that work very good on me because I'm a sucker for games.
It's like, woohoo, experience points.
That's right. There's even I'll talk about that in the next one. A straightforward, progressive way to advance toward winning. So essentially, you need a way to progress towards it. It needs to be simple. That's one of the things sometimes people try to overthink the strategy to maximize the efficiency. But if you make the rules too convoluted, if it's not straightforward enough for people to understand, their brains will explode and they'll maybe sit back and go, oh, it's mathing. And then they'll want to quit.
Minimize the mathing.
Minimize the mathing for people. And then a prize that's commensurate with the effort required to play the game, ideally one that comes with an element of status. For example, finishing first place merits a bigger trophy than second place. So that's the idea that you give out big trophies. This would also fall into there. The most probably common tactic for gamification would be like badges. So you post 15 times, you are a poster. And if you interact with 15 different people, you're social. And, so badges are used here. Going back a long way in forums would be the idea of ranks. So, upon your 7,257 post, you are a super senior member of the forum. So there's a lot of great ways you can do this. And I think, it's something that it's tough if you don't have a little bit of time or an automated way to track it. You'll find there are probably some plugins out there for WordPress that maybe make some of this stuff easy if you want to try to apply it into your website. But also remember that it needs to be easy for you as well as the people doing it, because most of us are small businesses. We don't have big staffs and massive mainframe computers to be able to calculate stuff.
And that's when things like Rafflecopter, Thunderclap is it's a sharing website. So you put up like a campaign that, I'm trying to sell my book, or I'm trying to sell my course, or I'm trying to publicize something. And then you encourage people to share it out through Thunderclap.
Or a fun one for yourself, if the issue is productivity. If you like games, especially like RPG games, Task Hammer, it is an application that it's a simple task manager, but you gain experience points and you can sort of set up levels, and it's like a little RPG game, but the actions you get experience for are tasks that you complete.
Yeah, that's actually if you're looking for something to kind of help build habits, Task Hammer is really good for that, because you can set up your own tasks and how many points they're worth.
Yes. My only problem is your character doesn't die if you fail to do tasks. That's my only problem.
Okay. They'll have to work on that. Okay. My news this week isn't really an article. It's more of a deadline. The January 15th estimated tax payment deadline is coming up very quickly.
When's that?
January 15th.
Okay, thank you.
This is the last estimated tax payment for 2015.
Woohoo.
I don't know if that's woohoo.
Well, it's the last.
When you have to write a check, it's not
I guess
a
you have to start over the next year, huh?
Yeah. Yeah. So you're going to want to make sure that you make this payment, because if you owe on April 15th, not only do you have to write the check for that, but you also have to make your first estimate for 2016 on April 15th.
That's the one that really annoys me personally. It's like, oh, this is tax day. Oh, plus you're going to start paying taxes for next year on the same day. That seems kind of bogus, but I guess if you want to fight the IRS on that, good luck.
This is a really good time to get in touch with your accountant, make sure that your estimates are in line with where they need to be. You might want to pay in a little bit extra, or you might end up paying in a little bit less based on your performance last year. But, now is a really good time to get in touch with your accountant and get that estimate straightened out. Okay. And so that kind of leads into what we're talking about this week, because this week's topic is taxes.
It's funny that Boo Kitten came in right as you went to do that.
Because she's the cat of evil.
She's the cat of evil.
So she had to be here for the tax discussion.
AKA Anubis.
So, we're going to start off talking about 5 common errors that people make. Some of these you can, correct for 2015, and some of these are going to be things to keep track of for 2016. Okay, so the first common mistake that a lot of small business owners make is they have poor record keeping.
And that's a business killer.
Well, because, the thing is, it's like, it's a new year. We're all excited, to get going and grow our business. And then you have to spend 80 hours working on your taxes because your records are bad.
Yeah.
One of the biggest things that drives me crazy as an accountant is when I ask people for their mileage and they say, oh, we'll just use what you used last year. No.
Oh, so your 2 logs when you get audited match. Exactly. That's interesting.
Right. So you need to make sure that you keep a mileage log. And my mileage is actually, it's a 2-part. So I have my calendar, which documents everywhere that I go. And then I also use the Mile IQ app. And that actually tracks all of my trips. So my mileage is in Mile IQ. The who, what, where, when, why is all in my calendar. And the 2 of them, I use the 2 of them together to come up with my mileage log. And if you're interested in checking out MileIQ, I actually have a 30% off coupon that'll be in the show notes for episode 18.
Oh, awesome.
Okay. So, if you don't have an accounting system, something like QuickBooks or Xero or Wave, this is the time to start, right?
Yes.
New year. The great thing with all of these systems is that you can download from your bank.
Yeah.
And the bank feed saves me so much time.
Now, when you say the bank feed, is that the part where once you say that this expense is that, it'll automatically put it in there for you for the future?
Right. So, I buy a lot of my office supplies at Staples. And so when QuickBooks sees a transaction and it's Staples, it knows that those are office supplies.
Yeah.
And 90% of the time I'm buying office supplies at Staples. Every once in a while, I'll buy a printer or something like that. But that really saves you time because everything is automatically categorized. You just have to check them all off and say, yes, those are right. My bookkeeping for my business probably takes me about 15 minutes a month. I've been talking to people the last couple of weeks and they're like, oh, I'm dreading doing this because it's going to take me, weeks to get it done. Check out QuickBooks Online, check out Xero, check out Wave. I'll put links to all of them in the show notes. And if you're interested in QuickBooks, I'm a QuickBooks Pro advisor. So if you reach out to me, I can actually give you better pricing than what they're offering on their website.
And two, correct me if I'm wrong, for a lot of these, it's like there's usually a little bit of a setup to get the accounts, but if you get it right, it will really save you a lot of time.
Yeah, well, a lot of them now, like when I first started using QuickBooks in the early 2000s, you had to set up everything manually. Now, all of these programs will ask you what industry you're in, and they will set up all the accounts for you. So it's really taken a lot of the setup work out of the equation.
That's awesome.
Yeah. So you can get any of these systems set up probably in about 15 minutes.
Oh, wow. That's because I remember doing that years ago because this was one of my flaws was poor record keeping. I was horrible at doing it. And obviously I had help setting up my QuickBooks, but that was a bit of a chore.
Yeah, now it's really easy. You just select what industry you're in. It knows the common accounts that all people in that industry have, so it's super easy.
That's awesome.
If you're putting your goals list together, if you have really poor bookkeeping habits and record keeping habits, this is a good time, to get a good system in place because then you're not trying to play catch up at the end of the year. Typically what happens if people don't set something up by probably April, they won't do it.
You're done.
They're like, oh, I'll do it next year. And then next year comes along and you still don't do it. So the second item on my list, mixing business and personal, because this complicates your record keeping and you get to the point where you don't know, if you bought something last March from Amazon and now you don't know, well, was that a business purchase? Was that a personal purchase? And then you got to look it up and it takes you more time. Keep business and personal separate. That's why I'm a huge fan of having an employer identification number and having a separate bank account.
And we should see if we can find a lawyer we know. Someone who could talk about the actual liability risks to doing this as well, too, in case of lawsuits.
Yeah, you could run into some liability issues if you mix business and personal. But, keeping the finances separate is going to make your life a lot easier. And remember that in order to deduct something for your business, it has to have a business purpose. So, a lot of people will say, okay, well, I am going to get one of those advertising wraps for my car. And then my car becomes an advertising expense because it's like a moving billboard.
I wish that was true.
That is not true.
No.
You can deduct the cost of putting the wrap on your car, but you can't deduct your car as an advertising expense. Okay.
What if I have it painted permanently?
No. The cost of the painting can be an advertising expense, but you can't deduct your car and say that it's a moving billboard.
Okay, well, could I charge rent to myself?
No.
Oh, okay. Well.
You also have to be really careful. I get this a lot from contractors. Clothing is typically not deductible in your business. really the only clothing that, the IRS is okay with you deducting, if you're a mechanic and you have one of those like mechanic jumpsuits or steel-toed shoes. Because the way the IRS looks at it is if those clothes could be used for personal use, then you can't deduct them.
Okay.
And in recent years, they've gotten really strict about it. So there are soldiers that tried to take a deduction for their fatigues,
which the Army requires them to purchase after the initial.
Right. But when fatigues got really popular and people were wearing them, no, I swear to God, so that's been one thing that's been pushed off the table. Nurses and scrubs. The IRS was giving nurses a hard time about that because people were wearing scrubs on the street. I don't know why, but they were. So, definitely, things like jeans, if you're a contractor, if you buy a jacket because you're outside, and you work in the weather, those things are not deductible. Dry cleaning is not deductible. Hair and makeup is not deductible. There was a case not too long ago where an anchor woman tried to, this is a TV anchor woman, tried to deduct her dry cleaning and, her makeup and her hair care. And the IRS said, no, that's because you're going to do that anyways, right? You're going to buy makeup. You're going to do your hair.
I wouldn't.
No. Well, you don't either way.
That's right.
So it doesn't matter. So, if the deduction could be construed as something you would do no matter what, it's not business. You're making a face. Mm-hmm. I'm surprised you didn't have like your brain just explode.
It did internally.
Okay. So, things have to have a bona fide business purpose.
I'm trying to keep this an explicit free episode.
Yeah. I know this is a tough one to have you on, huh?
Yes.
I'm sorry.
Especially the BDU thing, really. Or saying, it's like, hey, you're required to wear a uniform at work like scrubs and you can't write that off. That's bogus.
Well, and that's why like a lot of hospitals actually started providing them for their employees.
Gee, I wish the government would provide BDUs for soldiers. Oh, wait, no.
So, make sure there's a bona fide business purpose for this. And it's not something that you would do anyways. That's why and we're going to talk about home offices later, but you can't deduct your home phone because the government assumes that you would have a landline in your house anyways. And I'm worried that these laws are going to change and they're going to start applying to cell phones.
I know. I find that kind of bogus though, because it's like less and less people actually use landlines in their homes now. And so I would argue just the opposite where, especially with younger people today, they might not even have a landline if it wasn't for a business.
Right. But the IRS is still, they're still catching up. They're a little, it's still like 1984,
yes.
at the IRS. So, but I'm worried that they're going to start catching up and go, well, everybody has a cell phone. So you would have a cell phone anyways. You can't deduct that for business. But that hasn't happened yet.
So I guess I should just shut up about the landline one and hope the cell phone stays deductible.
Right, exactly. And again, with something like a cell phone, you can only deduct a portion of it that's used for business. But when you're thinking about that, don't just think about the phone calls you make. Like I do 90% of my business email through my cell phone.
Yeah.
So think about the research that you're doing, think about, the emails you're responding to. Are you doing social media for your business? Mm-hmm. And try to figure out what percentage of your cell phone you're using. Because the call standard that people used to use really doesn't apply with smartphones.
Well, and that's completely true because it's like I try and do most of my interaction in Facebook through my smartphone because I don't want to get into it when I get home. So like if I'm out somewhere and you're walking into the store, you look for any comments to reply to, that kind of stuff. Because I try not to do that at home, actually.
Make sure that things have bona fide business purpose and things like your cell phone. You've got to make sure that you come up with a good strategy for how you break out the business and the personal. If it's something that, you're really not comfortable with, go on the low end of things. So for my cell phone, I probably use my cell phone 70% for business.
You probably say 50 or something.
But I say 50, just to give myself a cushion. Number 3 is about employees and subcontractors. A lot of small business owners think that if we decide that somebody is a subcontractor, then they are a subcontractor and they're not an employee. The IRS would disagree with you on this one.
And this is one, too, that I know just from talking to you, they've become very aggressive on. And they make it very easy for people who are subcontractors to essentially report their employers for making them work inappropriately as an employee when they're a subcontractor.
Right. So you have two different governments that are cracking down on this. The IRS at the federal level has designed a form that if someone is treated as a subcontractor and they don't think they should be a subcontractor, they can report the person they worked for. And then states are stepping up their enforcement because everybody's unemployment fund is broke. And so when you have a subcontractor, no one's paying unemployment insurance for that subcontractor. And the states really don't like that. States are really stepping up enforcement because they want people classified as employees. Yeah. If you have someone working on site, so in your office, they may be an employee. If you have complete control over their schedule, so if you say, hey, you need to be in my office from 8 to 5 or from 8 to noon.
You're pretty much done at that point, aren't you?
You're pretty much done at that point. If you are branding this person as part of your organization, you are probably going to run into trouble because you're making them sound like they're part of your company.
Which I think could end up being a big risk for a lot of the internet entrepreneurs who use virtual assistants and try and make it feel like they're part of the club, which isn't wrong to do, but you have to be very clear that this club member is a virtual assistant and you can actually use them for work if you want to. But they work with me all the time and I love them. So they're interacting, but they're not yours.
Yeah. Another thing to look at is if you're paying someone as a person rather than paying their business. Yeah. You can run into trouble there as well. Because typically, in order for someone to be a subcontractor, they're supposed to be in the business of doing whatever you've hired them to do. So if you are the only person they do that for, the IRS gets really suspicious. So, it's better. And that's why, like, a lot of times with IT, they ask people to set up their own business and get an EIN before they'll pay you as a contractor.
Or at least have a DBA wherever you are. And that's not the computer kind, but the doing business as.
Right.
At least have an alternate name they can write the check to.
Right. So, when you're working with subcontractors, ask them if they have their own business, pay them in the name of the business. It's a good way to protect yourself.
Do not hand out personalized addresses from your domain for your business to any subcontractor. If you have one, like a personal assistant who deals with all of the help, do not make it Jane Smith at, yoursite.com. Make it help at yoursite.com, and then you forward it on to her email address.
Right. Or customer service.
You can give her access to it, but you, once again, you fall into some dangerous territory once you start naming email accounts for people. Giving
them business cards.
Yes.
Because again, you're branding them as part of your business and you want to avoid that. Okay. So the next thing has something to do with contractors. Number 4 is not sending out 1099s. Okay. I know that 1099s are a pain in the butt. Okay. You have to send them out by the end of January to the individual or the business that's going to receive them. It's a pain. I know, because I prepare them for clients. It's obnoxious. The penalties for not sending 1099s are incredibly high. Okay. This is a penalty that if you get knocked for this could put you out of business.
Wow.
Okay. The penalty for not sending 1099s is $250 per person or business per copy, which means you're required to send a copy to the business and to the IRS, which means that's $500
minimum
for every 1099 that you do not send.
You're saying per person per business. So like if you do,
So per 1099,
Okay,
right?
per 1099.
One to the recipient that you paid, one to the IRS.
and is that one too? Like if they don't do it, will they go back years and see if you did it the previous year and the year before, and pretty much you're done?
Yes, that is one that they will go back. And there's actually a question on all business tax returns, whether it's a partnership, a sole proprietorship, an S corporation, or a C corporation. They will ask, did you have anyone eligible that you should have sent a 1099 to? Yes or no? Did you send 1099s? Yes or no?
Now, what is the threshold for that for people so they know when they have to send 1099s?
Okay, so the rule for 1099s, you have to send them out for individuals or businesses that do work for your business. So this isn't personal stuff, okay? You need to send them out if the business is a sole proprietorship or a partnership, whether or not they are an LLC. Okay, so a lot of people see LLC and they go, oh, that's not a sole proprietorship, and they don't think they need to send them out. If a business or an individual provided more than $600 worth of product or service to your business and they're a sole proprietorship or a partnership, you need to send them a 1099. Now, this includes if you rent a building, you should be sending one to your landlord.
Oh,
There's a line on the 1099 for rents paid.
okay.
If you pay your CPA more than $600, if you pay an attorney more than $600, if you pay a repair person more than $600, you should be sending them a 1099. And again, this is out of your business. This is not personal.
This isn't your vehicle that you can't write off as an advertising expense. This is, you get computer repair done on a computer from a local business.
Right. So, right. If you have computer repair, if you have a website built, if you do graphic design, think of all the businesses that provide services to your business that could potentially be a sole proprietorship or a partnership. So there could potentially be 10 1099s that you need to send out this year. And if you don't send them out at $500 each, that is a $5,000 bill just for this year.
Wow.
And
I didn't realize it. So that's actually a business killer. I had no idea was a business killer.
Yeah. So that can be huge.
And see, this is where I get upset. One, they're pushing the expense of this off onto all small businesses against other small businesses because they have trouble tracking the money. But then also it creates an unintended consequence that, oh, wait, I could go to local Dr. Computer Smith Repair or Best Buy. Where am I going to take my business?
Right. And that's the thing. It discourages people from working with small businesses because they don't want to have to do the 1099s.
Yeah.
So, one thing, there's a form that's called a W-9. It's an IRS form, and it gives you all the information that you would need to fill out the 1099 for a business. Because essentially what you need is the name of the individual or the business, their address, and their social security number or their EIN.
And if they have both, make sure you get the EIN.
Yeah, get the EIN. And then they sign the form. Do not pay a subcontractor until you have that form in your hand. Because what happens is, as the accountant, right, in January, I will go through your records and I say, hey, look, it looks like you're going to need to send 1099s to these people. And then we start hunting people down for their EINs.
And then you're racking up the bill with the CPA and more likely to have to send them a 1099.
Well, and the thing is, the thing I find is that after people have gotten paid, they don't want to give you that information because they don't want to get the 1099.
Yeah, it's a waste of their time at that point.
So, the thing is that they're hoping that the income's not reported.
Oh, I see. Yeah.
So trying to chase people down after the fact is really hard. If there's a contract between you and that person, send out the W-9.
And even just I'd add it in with the thing that, hey, you will not receive payment until the 1099 has been.
Until the W-9 has been received. Yeah. So, and I'll link that form in the show notes for this episode. So that way you have it. I mean, the thing is that, the IRS right now, is very aware of the fact that there are a lot of small businesses out there that are not reporting all their income. That's why if you do anything with a credit card processor, you actually get a summary of all the sales that were generated through their payment processing, and a copy of that goes to the IRS. That's why the IRS loves credit card processing. They hate cash businesses. They're stepping up 1099 enforcement, which this is actually better than it was supposed to be.
Oh, good.
Because when the Affordable Care Act was first passed, the government wanted you to send a 1099 to any business that you did business with that was more than $600. So that's like...
So you have to send it to like GE if
GE, Staples, Best Buy, your electric company. I mean, it was insane. And we lobbied, the AICPA and the state societies lobbied and said, this is insane. Because every small business is going to be sending out hundreds of 1099s. Yeah. It's just not feasible. And so finally, they pulled back that requirement, and the requirement's still the same as it used to be.
Now, is that an official, like it's like dead, or is it one of those that's been temporarily suspended and it might come up again?
No, it's dead.
Okay, good.
It's dead. Okay. But, you still have to make sure. And the nice thing is that if you have, any business that you think might be either a sole proprietorship or a partnership, they can check off a box of what type of entity they are. If they check off that they're a corporation, then you don't have to send them a 1099. We talked about having, an accounting system before. Most accounting systems will generate reports or actually generate the 1099s for you, as long as you set up the vendors correctly.
Correct me if I'm wrong here, but like some professions, like I'm not sure about doctors, but lawyers and CPAs, they're always one of the two, aren't they? I mean, there's no like corporation with accountants in there, are there? That does public accounting at least.
You can be an S corporation. So, but most accountants run as either a sole proprietorship or a partnership. So, that is a huge one that I'm working with, with my clients. And that's why I like to see their books really early. So that way I can see if that's an issue for them. Okay. And even a lot of times, if I see my clients' books early, because the thing is, the federal and state copies are not due until the end of February. So if you get in with your accountant early, your accountant might just do a 1099 for themselves, just so that, you've got 1099s being submitted. Okay. But that's why good record keeping is really important, because if you don't get your taxes together until April, you're going to miss this deadline. Okay. So that's another reason to have really good records. I think this is one of the ones that Jeffrey thought was the business killer, number 5. Number 5 is not making estimated tax payments.
Yes. Well, the two I was thinking was poor record keeping, but mainly failure to make estimates.
So you are required to make estimated tax payments if your amount due when you file your taxes is going to be more than $1,000. Okay, that's rule number 1. Rule number 2 is you have to pay in at least 100% of last year's tax. So even if your income has grown a lot since last year, as long as you pay it in 100% of last year's tax, you'll avoid penalties.
Yeah. You'll still get the tax bill, but...
Right. You'll still have to pay the tax bill. But then, as we mentioned earlier, when you have a big tax bill in April, and then you need to make that first estimated payment in April as well, you get into this horrible cycle where you don't have the money to pay both.
Yeah.
And then you go another year without making estimates, and you fall into this trap and you end up paying interest and penalties. Get in the habit of making estimated tax payments. It is a good thing to do. Most accountants, what we do, because of that 100% of prior year rule, we will base your estimates off of last year's tax. Okay. If you are not a good saver, or you are worried about, your tax bill being much higher, then you can meet with your accountant on a quarterly basis, as long as you have good record keeping.
Yeah.
Right. And that's another reason for good record keeping, is so that, I look at my numbers every quarter, and I say, okay, so where are we compared to last year? What do I think that's going to do to our tax bill? And I monitor those things. Now I also don't like giving the IRS any more money than we have to, so I make sure that we're paying in that 100% of last year's tax.
Now, here's a question. What about for your small business that is the part-time small business where they work full-time? Can they just make sure to pay in a lot of money through their employer, and then not make the estimate payments, or do they have to make the estimate payments no matter what? Yeah,
as long as you pay in 100% of last year's tax. You can do that through withholding, through estimates. If you sell some stock and you have a whole bunch of money withheld from that, that's fine.
Okay.
As long as it gets there by January 15th. And the other thing too is that if you make if you make like one big estimated payment in January, you can still get penalized because the IRS expects that you're going to pay that money in quarterly. So you can't just say, oh, I'm going to make one big estimate in January and that'll cover all my tax for the year. You can get penalized for that.
Of course.
One way though to get around that is any money that's withheld from a paycheck is considered paid in January 1st of that year. So if you look at your taxes in November and you say, oh crap, we're going to owe a ton of money, you can adjust your withholding at your job, have a whole bunch of taxes taken out, and you won't get penalized because they don't know when that money came out of your pay. And then you can just adjust your withholding for the first paycheck in January again.
And part of that too, I think you have to kind of know your employer. Like certain employers might be very slow to be able to do it. And maybe you only have 1 or 2 pay periods left or whatever. And, you only actually pay the higher taxes on one of those two. So you got to kind of know how good your employer is if you're going to play that game to actually have some taxes taken out too.
Right. But one strategy you can use is you can have more money taken out of your W-2 if you don't want to make estimates or if you forget to do it or, that's another way.
Yeah.
Okay. So those are my 5. Okay. Those are the 5, common mistakes that people make. Okay. Now let's talk about some things that could save you some money.
Woo-hoo.
Okay. This is the better part. Yay.
Yes.
Okay. I wanted to get you through the painful part first and then, So the first tip that I have is to set up a retirement plan through your business. Okay. There are a number of options for small business owners for retirement plans. These are retirement plans that are actually within the business. This is not like a traditional IRA or a Roth IRA. Okay. And the 3 most popular options are a SEP, a simple, and a solo 401k. Okay. So these will allow you to put away a lot more money than a traditional IRA would. Okay. So even a simple plan will allow you to put away $12,000 a year. Okay. So, if you've got extra money in your business, you want to be able to put it away for your retirement. That is a great way to do it.
So you probably also use it if, until the point you could afford to put more than 12,000 in.
Right. Right. And you can also put in a match that's equal to 3% of your profit as well.
Oh, on top of it. Okay.
Yeah. So, and all these different plans have different rules. So you're going to want to sit down with a good financial planner and your tax person to figure out what's the best for you. Okay. So that's the first one, a retirement plan within your business. Okay. Those plans, no retirement plan will decrease your self-employment tax. It will only decrease your income tax because they use the same rule that they use for people that work for employers. Okay. The next tip, and I love this tip. Okay. And not enough small businesses do this. Put your spouse or your kids on payroll for your business. Now, in order for this to work, they actually have to do work in your business.
Like coal mining.
Unless you're in the business of coal mining. But a lot of states, they won't allow you to do that. This could be, that I pay my kids a reasonable hourly rate. You can't pay them like $90 an hour. Okay. It's got to be a reasonable hourly rate for what they're doing. But maybe you pay them to do filing for you. You pay them to, if they're older, update things on your website or automate your social media, shredding. Okay. If you're in a business where you're mailing product, they could be helping you mail product. The nice thing is if you put your kids on the payroll and they're under 18, you do not have to withhold Social Security and Medicare tax for them.
Wow.
Okay. So they will get a W-2 at the end of the year because they're on payroll, but your kids get their own standard deduction, which means that you can pay them up to the standard deduction amount and they won't pay taxes on that money.
That's awesome.
Isn't that? So that's really cool, right? Because it saves you income tax, right? It's deductible for your business. It's a way to get some money into your kids' hands.
Get them in the habit of working.
And then the nice thing is if you pay them, okay, and if you've got some extra money lying around, because they have wages, you could set up like a Roth IRA for them. And a Roth IRA is post-tax, which means you pay taxes on the money and then you put it in and it grows tax-free and they never pay taxes on it. If you do that and you pay them, you pay them amount so that they don't pay any taxes on it, and then you put money in the Roth and there's no tax on that either, you just got like the best tax deal ever. Because you're not paying taxes on the money you put into the Roth, and your kids are going to be able to take that out tax-free when they retire.
It's awesome.
No tax ever.
Wow.
Right? That's awesome.
Until they close that down. And
in most states, if you have a sole proprietorship, you don't have to pay unemployment tax on your spouse or your kids. Okay. So, that's another tax that you don't have to pay for them. So and if you have a retirement plan within your business and you hire your spouse full time, your spouse can put money into the company's retirement plan also.
So you can double what you're retiring.
Right. Exactly. Think about some of these strategies. If you've got questions about them, reach out to me through the website or grab me on social media and we can sit down and talk about this. But this is a great strategy for kind of helping, spread out some of the wealth that you're generating, to your kids and your spouse and put more money away for retirement.
Awesome.
I like that. That's a good strategy. Okay. And then my last one, a lot of small business owners are really apprehensive about this. The home office deduction. I love the home office deduction because especially if you live in a high cost state like Connecticut, the home office deduction can save you a tremendous amount of money in taxes as long as you do it correctly. A lot of people are kind of squeamish about this one because, their accountant who's like in their 60s is telling them that it's a high audit risk. That was back in the 1970s. Okay. In the 1970s, the home office deduction, that was one of those things that the IRS was super hyper focused on. And it's not anymore. Your overall chance of being audited is less than 1%. And the vast majority of those audits are people who take the earned income tax credit. So if you have a small business and you take the earned income tax credit, you better have immaculate records. Okay. In order to take the home office deduction, you need to have a place in your home that is regularly and exclusively used for business. Okay. So that means that you can't have, you can't say my part of your couch is a home office. You can't say that a portion of your dining room is a home office. Okay.
Unless it's all you use it for.
Unless that's all you use it for. And we have in the past, as we shuffled stuff around the house, we have actually converted the dining room into a home office. Like a lot of times in cases that I've seen, if you have like a TV in your office or you have an elliptical or a treadmill in your office, that will kill the home office deduction because they're saying this isn't being used exclusively for business because you're exercising in here, you're watching TV in here.
What if I put an advertising sticker on my treadmill?
You can't. No, that won't work either. Just like the car, it doesn't work. Sorry.
Just one.
But if you have a room that has, your desk and your computer or a docking station for your laptop, we have 2 rooms in our house that we use. We have the one room that's the recording studio. And it's also our
The
business library.
It's also the brainstorming for business. And
yeah, this is kind of the room that we come to when, we're recording, we're brainstorming, we're editing, all of the business books are in here, although my business books look a lot different than your business books.
Huh.
Yeah.
No, I don't see it.
Yeah, the mythology and the weaponry books.
But see, I'm a very abstract person, so I just see it at the widget level. I don't see it at the detail level.
Oh, I'm sorry. Yes. And then we also have a room that our computers are in with our desks, that we do the majority of our work from. So, you have to have a place that's regularly and exclusively used for business. Once you have that space, you can deduct. So you get the square footage of that space and you divide by the square footage of your total house. Okay.
And that would, I'm assuming, have to match whatever it says for the MLS or whatever your town records are.
Yeah. And, I've talked to some accounts that'll say, well, you can deduct, the common areas like the hallways and I don't do that.
Yeah.
I take the MLS, whatever the town says the square footage of your house is. So let's say that your house is 1,000 square feet and you use a room that's 250 square feet for your home office. That means that 25% of your home is your home office. So that means that you can take a deduction for 25% of your mortgage interest, 25% of your real estate taxes, 25% of your utilities, excluding your home phone and your cable TV, right? You can't take those too. 25% of general repairs and maintenance. So if you pay somebody to mow your lawn or you buy gas for your lawnmower, toilet paper, paper towels, cleaning supplies, you can take 25% of all that stuff. But that also means that you have to have really good personal records.
Yeah.
Okay. And if you have something like QuickBooks Desktop or even Wave Apps has a free personal financial
that's cool
tool that you can use. So you can actually set up like a separate account for your personal stuff. So that's pretty cool. But, it's tracking, right? So, but, the nice thing is that when you add all that up, especially if you live in a high cost state, that can be pretty significant.
And that one also does not phase out, correct?
That does not phase out. It cannot take you into a loss. Okay. So, but the nice thing though is that any expenses that are left over will carry over to next year.
Okay. So you'd have a head start in the next year.
Yep. So that is a great deduction. I really like that one. Like that and mileage are two that I don't think people are using, they're utilizing well enough. So, again, though, it comes down to record keeping, so in our personal budget, I have a line item for cleaning supplies. I have a line item for repairs and maintenance that I know are deductible for the business.
Yeah.
The better your records are, the more deductions you'll be able to take advantage of.
And I think a fair statement here would be, we would also not suggest people to try and estimate that, because if they get audited, they'll be torn apart.
Now, here's the interesting thing though, is that if you don't want to track it at all, the IRS has a new method for the home office deduction where you can take the square footage of your office and you multiply it by the annual rate. The problem is that the rate sucks. The rate is so low that even if you have partial records, like you just have your mortgage interest and your real estate taxes and your utilities, you're going to beat it already.
Or at least in a high cost state.
I found in most states.
Okay. Wherever you've looked at it so far.
Right. Where I've looked at it so far. And the thing is, it's like, they call it a safe harbor, and typically safe harbors with the IRS are really, really terrible. So,
like most safe harbors, actually, there's a reason they're safe. It's because there's no real benefit. Right.
The benefit is very low. So this is something, this is even something that you could, if you had a space that was exclusively used for business in 2015, this is still something you can put together for your 2015 taxes, and then keep better records for 2016.
Yeah.
Okay. So those are my three opportunities. Think about retirement plans, and some of these retirement plans you can still set up for 2015. Okay. Like a simple plan, you can still set up now.
Cool.
Okay. And use it for 2015.
Is there a deadline for that?
The day you file your taxes. Okay. But the sooner you get it done, the better. Mm-hmm. For 2016, you can think about putting your spouse and your kids on the payroll. Make sure that the payroll company knows that they are your spouse or your kids. Okay. So that things get processed correctly. And then think about the home office deduction and are you utilizing it properly?
Okay.
Okay. So I know that went a little bit long, but I know that there was like a ton of information in there. And these are like questions that I get asked all the time.
Yeah.
So, I hope that you stayed with us, to the end of that. So my tip has to do with estimates, right? I'm really on an estimate kick, Use reoccurring events to remind yourself to make your estimated tax payments.
So automate it.
Right. Automate it. I'm all about automation. So our app of the week actually has to deal with that as well. I love my Google Calendar and I love Nozbe.
And I've paid for an app on my phone, but there's a free version as well called Business Calendar 2, which has a wonderful widget for an Android phone. And I love that.
So, both of these, either a digital calendar like a Google Calendar or Nozbe, you can set up reoccurring tasks or reoccurring reminders that will pop up to tell you to do something, like make your estimated tax payments.
And here's a reminder. If you set up reoccurring events that you need to make sure that you remember, make sure, especially if it's a Google app, that there's a notification for it as well.
Right. Make sure that you're getting notifications. Correct.
And usually the further out they go for me, like time-wise in between them, I might even use a couple. So like, if it would take me a couple days to go, oh, I need to put stuff together, I would have a couple day one and then a day of notification. There's a lot of flexibility with that.
Right. So that's the thing. So you can have it, especially with an estimated tax payment, you may need to shuffle money around in order to be able to make it. You've actually got to write the check. You might want to have something that reminds you 10 days early that this is something you've got to do, and then remind you again in 5 days, and then the day of.
Yeah, especially something like with taxes where you might need to put money together. So
right,
depending on how easy that is for you would indicate on how long out you'd want to set the first notification. Right.
And I'll put a link to Nozbe in the show notes, but Nozbe actually has a 30-day free trial. I can't tell you how much I got done this week because I took things that were in my to-do list and I made them next actions. And we talked about that in goal planning. And I just looked at that list and I'm like, all right, what's next?
Yeah. And the thing is, if you have multiple things that you're doing, you can have next actions for family and create a special label for it. So when you're doing chores, you can sit there and go, what do I need to get done around the house?
Right.
What do I need to get done for my book? What do I need to get done for the cats?
Well, and it's like, I even had one last week, because one of the cool things with Nozbe is you can actually make checklists inside a task. And so I'm like, okay, I need to go to Costco this week. And as I was thinking of things I needed to pick up at Costco, I would actually, open up Nozbe on my phone, add it to that checklist. And when I'm sitting in Costco, I could check everything off as I bought it. So it was great because like a lot of times we have multiple systems that do these things. Nozbe handles it all for me.
I love the checklist function, and I would advise you, and I believe you can do this in Nozbe, if you have any tasks that you need to get done that have a few steps to them, make up a quick checklist and it will always be there.
Yeah. So I actually did that with a client that I was working on this week. I was doing write up for the client. So I actually created a checklist that was, January, February, March, April, May, all the way through the year. And every time I finished a month, I would go in and check off that month.
It's easier to get started when you have to put it down and go back to it. Checklists are good things.
Yeah. So, check out Nozbe. They have a 30-day free trial. It really helps me stay organized. I've had a couple people this week. They're like, oh my God, you're so organized and you're great at time management. I'm really not.
No.
I am terrible at time management. But having tools like Nozbe, they help me become better.
Yes.
It's not that I'm naturally good at organization. I'm not naturally good at time management, but having things like Nozbe really helps me.
Yes. Give
the appearance of being good at time management. Right? So thank you so much for joining us this week.
We love you.
We do. You guys are awesome. We've had a ton of great shares this week. When we were actually down in Nashville, people were sharing out our stuff and it was awesome. If you know anybody that could benefit from the tax knowledge that we shared in this week's podcast, please, share it out, review it on iTunes, join the Facebook community.
Yeah.
The Facebook community is facebook.com/groups/smallbizlife. And, we're having a ball in there. People are asking really good questions. People are helping each other out. It is just awesome.
Awesome.
So we will see you guys next week. Take care and take some time this week for some self-care. Thank you for listening to Small Biz Life. If you enjoyed the show, please take a few minutes to rate and review the show on iTunes or Stitcher. Please visit smallbizlife.com to view today's show notes, take this week's poll, join the Facebook community, follow us on Twitter, or submit a question for the mailbag. Support the show by checking the resources page or by going to smallbizlife.com/Amazon whenever you shop.
This was Small Biz Life. This was Small Biz Life.